Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North, coming to us from over the other side of the world in the UK. How are you, Martin?
I'm very well. How are you going?
Yeah, really well. And every month we say the world keeps getting crazier, and as always, it has been.
Yeah, absolutely. Well, of course, we're back to our normal deep dive on some of the data. We had a interim chat a couple of weeks ago on how to fix things, and I tell you, the issues that we called out have been magnified even more over the last couple of weeks. So this is, I think, a very relevant follow-up to that previous show.
Absolutely, and that show was really well received. Thanks to everyone. We got so many comments on that show, and
Mm.
people looking around in Australia and going, something doesn't feel right, and in a lot of places around the world. So it was good to give some solutions. And we sort of spoke about civil unrest on the way. We saw one of the biggest ever marches or protests in Australia over the weekend, and all these geopolitical issues that are sort of coming to everyone's doorstep all of a sudden.
And I'll just make a quick point. I was amazed at the way that the ABC reported the event in Sydney over the weekend, which gave it a really weird spin. It was almost like they didn't really want to admit that it actually happened the way that it really did happen.
Yeah, well, there's obviously so many layers to this, and the thing that frustrates me is people are, as always, it's divide and conquer. So people are now taking this side. I stand with this or this, and then we're going to probably see these clashes maybe continue and get violent. And ultimately, that's what the people in power want, to usher in, more laws and taking away your freedoms and that type of thing. So I think that's the playbook.
I'm afraid you're right. Now, I wanted to start this show with just referring to a recent post that I made, and I called it Markets Caught Between the Trade War Downdraft on one hand and the AI hype on the other, because that's how I see it, particularly in the US. And as to what's going to happen ahead, it depends on which of those two forces, both big forces, are going to play out. And that was picked up actually in a recent article in the Fin Review, which basically made the point that markets possibly are at risk of reversal. So the next month or so is going to be crucial. And it depends on this relativity between the trade wars and the issues to do with AI and how that plays out. So I think we're at quite a precarious state. And also bear in mind that traditionally September and October are quite weak months for the markets.
Yeah, I've got a lot of thoughts on this, Martin. I might have a bit of a rant once we get through your slides and you share your thoughts on sort of where this is all going with the tech and the AI. But the stock market remains near record levels after it had that big spew after the jobs numbers were revised.
Yeah, so the S&P 500 there, has been touching new highs quite regularly recently, and then it hiccuped on Friday when the job numbers came out, and then it recovered somewhat, although it's just down slightly overnight. And you can also look at the bond yields as well. The 10-year yield dropped considerably. Now, that's interesting because we'd seen yields rising and people were worrying about that. Of course, it means higher costs of government debt as well. That adjusted down, moving up very slightly again now. And just while we're talking, the gold was, close to all-time highs. Not quite there, but quite close to it. The oil futures dropped a little bit as well, not least because OPEC's releasing more supply. And of course, Bitcoin is waddling around 114, so still quite high. Not quite at the peak, but quite high too. So that's sort of the quick take on where the markets are. But I'm not sure that the current market indicators tell you the full story.
Yeah, I completely agree with that as well, which I want to get to in a second. But let's push on with what's driving this battle.
So let's first talk about the tariffs. And of course, the tariff wars continue. And if you go back let's say 12 months or so, 2 point something percent was the typical tariff in the US. Now it's at 17% after the latest announcements. And it's worth just parsing the tariffs from a couple of perspectives. There's the reciprocal tariffs. And of course, Trump has moved the dial up. So the euro settled on 15%, the Eurozone, rather than 10%. Australia's still got 10% at the moment. But then there are also tariffs that are on specific products and services, and I'm thinking here of the medical sector and some of the pharmaceuticals. I'm thinking of metals as well. Now, those are still being worked out, and those will come in. The third element, though, is the use of tariffs as a political lever. And of course, Trump has been hitting Brazil over the head because of the Bolsonaro issue, and so they've got very high tariffs just come in. And Trump is also threatening to impose secondary tariffs on countries buying cheap oil from Russia, for example. So we've got all of this morass going on in terms of trying to understand the dynamics. Now, my view is this is not going to get settled anytime soon. We're going to see this going on for months and months and months. Even now, remember, it's 92 days to get goods from China to the US, and China is still negotiating with the US about where their tariffs will be, and they've got more to go ahead there. So my point is, don't expect the tariff situation to crystallize anytime soon, which of course puts pressure on Powell and the Fed trying to work out what to do there. And just as another data point, next slide, you can see there that $29.6 billion was actually grabbed in tariff revenue, which was considerably higher than previously. And of course, that's allowed Trump to talk about, for example, maybe releasing income tax for low earners and those sorts of things as a way to sort of rebalance the economy, whether it'll be successful or not. But of course, on the next slide, you can also see that articles like, well, tariffs could smash US business profits, and all of those things are in the mix. So, you've got to say this tariff thing, it's an experiment, is quite fascinating to watch. And we've moved from taco, which is Trump always chickens out, to perhaps wacko, which means that the world is chickening out. And the euro, I think, is a good example of the world chickening out.
Yeah, I agree that it's going to get messy and continue, as any country that goes against, political stance or even religious stuff and everything going on at the moment. It's just such an interesting thing where he's playing this kind of this dictator role, and obviously he's not the one always pulling the strings with all his decisions and that type of thing, but it's just a crazy time to be alive, and we're seeing world firsts play out everywhere.
Well, I think he is ultimately making a lot of the decisions, and it's interesting that how his quote advisors sort of go back and check with Trump before they say almost anything. So yeah, unfortunately there has been an accretion of control around the White House and around Trump, which I find very worrying from a democratic perspective. And of course, we've still got the Epstein thing going on in the background when he's trying to deflect there, and there's a massive amount of rubbish going on. But the point is, these tariffs are very significant, not just in the US, but are going to have impacts globally around trade flows, and it will hit Australia as well.
Yeah. Okay, so tech versus S&P 500.
Yeah, so let's move on to the other side, the AI. So the AI, the big AI players came out with very strong results and are forecasting considerably stronger results ahead as well. Big capital investment programs from a number of them. But if you look at the impact of all of this, the S&P 500 is going, as we said, into new territory, but it is very narrowly based. So if you tease out the S&P 500 overall relative to the techs, we are where we've never ever been. If you look at the the 2000 and 2006, it's never been higher. So this is very narrowly based. And in fact, another way of looking at it on the next slide, if you look at just the three top holdings in the S&P 500, which is Nvidia, Microsoft, and Apple, 20.8% of the whole index is driven by just those three stocks. Now, that is a very, very uncomfortable position. The price-earnings ratio is very high as well. So however you look at it, you'd argue, I think, that the markets are probably well overvalued. And just to give you another perspective of that, you can see there that the deviations of earnings on the next slide, above and below long-term growth trends, well, it's high at the moment. But the question is it conceivable that it can actually continue at this level? So if you believe that the tariffs are going to crimp business performance and growth and profitability, and if you believe that this narrow base around AI is a little bit wobbly, then you'd have to say the markets are overvalued. And I personally think we're in for something of a correction at some point. I don't know when, but when I look at the fundamentals, I do get quite concerned.
Yeah, and my view, Martin, is a bit different. I think that the world is just becoming more and more tech and AI driven, and with everything that's happening. And so all these big companies, we're already seeing that even in Australia with Commonwealth, laying off all these jobs to either get cheaper overseas workers or AI. And so it's these big companies, as everything's become more and more globalized and buying out these small players over the decades, it's all become concentrated. My theory is that the real economy is heading into a recession or depression, yes. But the number on the screen of the tech stocks, and you might have the majority of companies on the S&P 500 struggling, but it doesn't matter if the big players continue to dominate, and everything's been done by AI. They're now literally building their own nuclear reactors. So that'll be an outlay, but then they'll have this monopoly over power and that type of thing. So I just think it's this crazy world of concentration of power, which is just bifurcation of real world economy and what the stock market and the numbers on the screen are saying.
Well, you've put your finger exactly on the issue that I worry about too, and that is that we are effectively under the control not of particular governments now, but of the AI, revolution, and those tech bros and the stuff that they're doing and the way they're playing the game. And they don't really care about the impact on real people. They don't care very much about the broader economy. This is all about making more money for the tech bros and their hangers-on. So it's the few percent. And the real economy is absolutely struggling. We see it in Australia. We see it in the US as well. And in fact, the bifurcation between the income levels of those few very large players and everybody else completely different. And of course, Tesla now has offered a whole bunch of new shares for Elon Musk to keep him sweet. And you think that they live in a completely different world. But unfortunately, they hold the reins of power.
Yeah, and not just the making of the money. I think it really is now the power and control. And we've seen someone like Palantir go on this run, and people have no idea what's coming with all this surveillance AI. It's 15-minute smart cities and that type of thing. Hopefully our audience does, but most people don't. But this is where once Palantir and that consolidate their power, they start to determine the price of the suppliers that they get chips off and power and who they contract and partner with through the government. So it's like supermarkets start to monopolize the dairy industry, and all of a sudden they're telling farmers what they're going to pay for milk. And so I see it as this big monopolization, corporatization of this technocracy that's going to happen through these Palantirs and that for control. It's not just about making money now. Once they've got that control, they determine who wins in all other markets. And free markets and freedom are kind of a thing of the past at that point.
Yeah, I'm afraid that I share that view too. 1984 is just around the corner. And the other point I'd make is that just before the dot-com bubble, of course, we had similar conversations about very elevated tech stocks, and everything's different this time. It's never going to be the same again. Now, there was a significant crash then. So the question is it going to play out, as we're saying, with effectively those technology guys pulling all the strings and driving into the future in a world that we probably don't want? Or are we going to see a significant correction? Either of those two futures are possible, but at the moment, I'm probably more convinced that we're going into the 1984 world than we're going to see a blow up like in the year 2000.
Well, hopefully not our audience, Martin, that won't comply. But for the most people, it does seem like they're going that way. But let's push on.
Well, the next thing we've got to talk about is statistics, right? Now, I've been saying, and you've been saying for some time, that the government's statistics are pretty suspect. And we saw a very significant example of that with the data that came out on Friday relating to the number of jobs. And of course, they basically made massive corrections from some of the earlier numbers. And the reason, of course, is that their surveys are not particularly effective. And we've been talking about this previously. I'd argue also things like the CPI measures and even the employment measures in Australia are probably a bit suspect too. So the point is, have we got a compass? Now, of course, Trump reacted very strongly to this and sacked the the messenger, as it were. Interestingly, some time ago, he was on the other side of the equation when he was trying to get back in, because then the numbers were actually relatively strong, and he was basically quite critical. So he goes all over the place. But the point is that he didn't like the message. 800,000 jobs disappeared over the last 9 months, basically, from the numbers. Now, I don't know what the right story is, but I thought this was quite interesting from Lisa. This is from Bloomberg, making the point that there's been lots of changes over time, over and under estimates from the first estimates that are coming out. But the really important thing is the response rate to the monthly non-farm payroll survey has fallen from 60% in the late 2010s to about 40% now. And the other conclusion that she had was there's not necessarily much sign of political interference based on the recent volatility. These numbers have been volatile. But my point is you can't trust the numbers. And that means we don't actually know what the real employment number is. But I suspect that the true unemployment is a lot higher than is being reported in the official numbers in the US and also in Australia too. And that's very significant when it comes to Fed decisions or indeed RBA decisions.
Yeah, that's a great point because with these surveys, you rely on people filling them out, and if you're a small business that's struggling or whatever, that becomes not a priority at all. Whereas if you're the big tech company and you've got doing everything by the book or whatever, you're filling out your surveys and probably painting a rosier picture. And we've seen some of these record business numbers, some of the stats that have come out of Australia recently, and that type of thing. So yeah, that's why I guess your surveys again probably more accurate with a lot of the data that you are getting, hopefully, rather than these people that are not filling out their ABS surveys and whatnot.
Well, I do it a different way, and of course, I'm talking to real people, which makes makes a big difference rather than firms. Now, of course, the Fed didn't move the rates last week, and in my show, I said the Fed stands pat, waiting for data. So they're saying, well, actually, what we're seeing is the jobs market is roughly balanced because we have lower demand because some firms aren't hiring, but the supply of workers is going down because of some of the migration changes in the US. So they're saying, well, the unemployment rate is roughly where it was. Now, that was before the BLS numbers came out, so that might change now. But anyway, the Fed was sort of standing on the sidelines, and of course, Trump said, no, we need to have rate cuts, rate cuts, rate cuts. But the other point I want to highlight is more and more as the Fed effectively reduces its balance sheet and still does more of the quantitative tightening, the Treasury in the US is issuing more and more debt. And on the next slide, you can see there, this is the one from the 31st of July, they made a significant issuance of short-term Treasury bills, but they bought back longer-term as bonds, right? Now, what they're doing is they're doing a bit of a switch from longer-term to short-term. Now, that has an issue because what it means is that they can issue a lot more bills and that can lift the amount of money in the system. You could also argue they've become a shadow Fed. So the other question about my question in that earlier show was, does that mean the Fed is becoming more and more obsolete? Because effectively, more and more of the functions of government are being coalesced around the White House and around the Treasury, and the Treasury operations under Scott Bessent is effectively almost working against what the Fed is doing.
At a time when there's been so much tension between Trump and Powell, I don't know if you saw that clip where they were going into the new Fed renovations or whatever.
3.1 billion. No, that's another building. It's hilarious.
Yeah. And again, this is another example of not money printing or not QE, or they say no, it's just buying at the shorter end of the curve and selling at the longer, and all these things where they're interfering with these markets to inject liquidity, keep things stable, get the interest rate they want, non-free markets.
There's still significant accumulation of gold by central banks. Not all central banks. The RBA has parked their gold in London and doesn't seem to care about it anymore. But some of the Asian countries are continuing to buy gold. So the gold price is being supported by central bank operations. And I think that's going to continue. So I think the gold price is going to continue to bubble higher, not least because, of course, it's also seen as a safe haven. There's a risk to the US dollar. And if you link that back to my earlier conversation about the Treasury putting more of their funding into the short term rather than the longer term bonds, that creates more uncertainty about government funding in the US, which in turn potentially has a risk to the quality and sustainability of the US dollar as a reserve currency, which again explains why it is that gold is also very much in vogue at the moment and will stay there.
Yeah, and that's an interesting convo that we've been having with a lot of our clients and on YouTube and videos and stuff. So, well, where do you park your money with the way the world's going? Because you don't necessarily want to chase gold when it's had this amazing run from 2,000 to 4,000, whatever. And same with Bitcoin. It's had a tremendous run the past 2 years, and you don't really want to see. I don't see property as a great investment that's just going to keep going up 8% a year like it has the past 40 years either. So, and then you've got your stocks, as you're saying, with record high overvaluations by the traditional metrics. So it's kind of like, what do you do at the moment? And I think you've just got to try and be paying down debt and thinking about what sort of lifestyle you want to live, what countries have the most freedoms. If you can't move to another country, move to another suburb or more rural and get out of the cities as this mayhem starts to pick up. So these are all the questions that people have to seriously start to ask themselves about having a plan B for the next 6, 12, 18 months in Australia and a lot around these cities around the Western world.
Absolutely. And in fact, it's the everything bubble, but it's also being created by, government printing of money, the fact that banks are able to create credit out of nowhere and lend that, and that creates more momentum. And in fact, if you look at it a couple of slides on, there's one where I've just called out the Australian M3. This is the money supply in Australia, right? And you can see there that the money supply is rushing higher, higher, higher because of high government debt, because of the magnification effect of that through the banking system. And it's interesting that property prices are tracking very, very close to broader M3, and it's true in pretty much every country around the world. So this money supply, this ever greater debt boom, is effectively creating more asset bubbles, but it's not necessarily sustainable. But look at wages. Wages growth has gone almost nowhere. That's the blue line on this chart. And so that's the first indicator that Australia has got a real issue. And of course, I see that in my surveys as well. And then if you just go to one slide above, you can see there that the real per capita GDP in the US is a lot stronger than Australia. So in Australia, it's 113. In the US, it's 127. It's indexed to 2010. So you can see here that the economic fundamentals in Australia are a lot weaker. That's, of course, partly because of very high migration, including a lot of temporary migrants and students, as we'll come on to a second, but also the fact that the economic momentum that the US has been able to create through AI hasn't been replicated in Australia. So economically, we are pretty much stuffed in Australia, and yet we've got that massive bubble up in terms of money supply, which is why we've got the everything bubble.
Yeah, that chart is insane. It's been doing the rounds on Twitter, and international sort of commentators starting to pick up on how bad this bubble has got. And if you look at how it's just gone sideways in terms of our wage growth, while this is starting to really take off parabolic, what if house prices do have another 20% move up here in Australia and we start to get towards 1.5 mil average house price? Like, you think people are stressed already and not keeping up with the cost of living and everything. Like, it's just got to the point where it's insanity. But then you've got to say, well, what's going to happen? And we've already seen BlackRock buy out 1.5 million homes in America now. And is it just BlackRock are going to come in and not let the property market, or every time it has a 10% dip, they're going to come in and outbid, the families and that type of thing? So this is just this insane world that we now live in, where who knows, even if most people can't afford to buy a home, does that even mean that the price of housing is going to go down if the BlackRocks of the world are going to come in and scoop it up and that type of thing?
Well, the chances are property prices will continue to rise higher, and there's a few charts there which show that. So there's an article that says house price to pay ratio is worst ever. That's analysis from Shane Oliver, AMP, and he makes the point that house prices have skyrocketed to a record close of 14 times the average annual wage, compared to about 3 times 100 years ago. And I also make the point, average wages this time is 2 incomes rather than 1 income. So we're off the scale, and he says it's just getting harder and harder. And this article also refers to the Demographic International Housing Survey, which shows, again, affordability in Australia, particularly in Sydney, is all over the place. And the next slide just shows you that the median price hit 1.5 million in Sydney, according to the Cotality data. So they went up again. And I've just included some data on Cotality that shows how the values have moved up pretty much everywhere over the past month, and over the past 3 months, and over the past 12 months, not uniformly. Regional Tasmania was down over the last month, and you can see there that there are considerable variations. I'd make the point that Hobart is still languishing. So over the past 12 months, up 1.9%, Canberra up 0.5% over the last 12 months, Melbourne just up 0.5%, Sydney up 1.6%. But look at this, Darwin, 8.5%, small sample, so not relevant. But then you've got Perth at 6.5%, Adelaide at 7%, Brisbane at 7.3% over the last 12 months. So you'd argue the likelihood is that we're going to see prices continuing to rise, which just puts more pressure on households. And as we'll see, mortgage stress continues to be an issue. And just on that, if you want 2 other data points on the supply side, the dwelling approvals, well, we did get a bit of a rise, but it's still well down on where it needs to be able to meet our targets. And in that earlier article, you'll see that there's a little quote saying, over the year, a total of 185,844 homes were approved across the country. Bit of a lift, but that's 55,000 short of the 240,000 needed every year to reach the government's 1.2 million target by the middle of 2029. So they're all off the scale there. And so I also make the point with building approvals, of course, it's units. So, it's very volatile, because if you have one block of units approved, which could be 20, 40, 60, 80 properties, then that's going to actually move the dial up. But actually, overall, it's not very good news. And interestingly, if you then go on to look at the credit growth, lending for housing is still rising faster than inflation and faster than wages growth. So we've got, on average, 5.9%. Interestingly, investor credit is growing 6.3% over the last year, compared with 5.8% relative to owner-occupied. So once again, you see this distortion. And by the way, we'll get the Q2 lending indicators on the August the 13th. The ABS stopped producing monthly statistics, right? And that's a real significant issue, because what that means is we don't really have a compass with regard to what's going on with new lending. The bank data is only stock rather than flow, and flow is the really important issue. And that takes me quite nicely to a slide a little earlier, where I highlighted the fact that the ABS actually is stopping some of their statistics. This is the Survey of Income and Housing. They won't release it. And why? Because they don't think that the survey's robust. Which is worrying, because again, what we're seeing is the ABS, either because they don't have the funds or because they don't like the results, are actually not releasing critical data. They're not releasing timely data now on the flow of credit, and they're not releasing timely data on the Survey of Income and Housing. And I've said for some time, I don't believe the CPI data either. So we've got a real issue with our statistical body as well. But the bottom line is, we are off the scale here when it comes to housing and housing inaffordability.
I can only remember this happening once, Martin, in the 8 years we've been doing this show, where they stopped reporting data. And I can't remember what it was, if it was just home prices or if that was during COVID or
Yeah,
something.
well, they used to do their own home prices, and then they sort of nicked the totality data, or CoreLogic as it used to be, and then they stopped publishing it.
Yeah. So do you think it's just they don't want to report on the bad news?
Oh, I think it's two things. I think they don't have the budget for a lot of things that they do, and therefore they're trying to prioritize. And they're trying to get the monthly inflation numbers sorted out. Later in the year, they're going to move to full monthly reporting, but the monthly numbers are all over the place. So at the moment, people are only relying on the quarterly. So problem one, they don't have the resources. And by the way, in the US, the BLS got defunded through the recent cuts as well. So that's one of the reasons why the statistical measures are not as good as they perhaps once were. And it's really important we get good data, because if you don't get good data, you can't make good decisions, right? And going on to the next slide, the RBA is basically saying, well, we may cut, but we're not really going to be able to cut much. And in fact, this article suggests they may only cut once or twice more, partly because they're waiting for the data. And Powell in the US is waiting for the data. But my argument is, if the data is duff, then how do we know where we are? And so they're making monetary policy decisions in the dark. And I would argue that probably inflation has been a lot stronger and unemployment has been a lot higher. And therefore, the whole basis of the way that they've actually been managing monetary policy for years is a bit messed up, because the data is messed up.
I think it's crazy in this day and age with AI and stuff that we can't get more accurate data or build better systems to get accurate reflection, compared to, these things have been around for decades before we had all these powerful tools that should be able to spit it out in a few seconds. But anyway.
It's crazy. And yet, our compass is bust, and yet we're still using the compass to make critical decisions. And that's a problem. And what happens is that as data gets removed and information is not shared, then it becomes more about what the politicians can say and spin what they like. Another good example of spinning what they like, of course, the politicians were talking about cutting migration. Don't believe it. This latest one shows that they're actually going to increase student intake by 25,000 in 2026, according to the national planning level, 295,000. And as Scott Phillips says, if we can provide additional housing, there are more than enough people already here or planning to arrive who can use that accommodation. This is nuts, and it is absolute nuts. And by the way, just on that, if you look at the next slide, it shows you where the temporary visa holdings are based on the top 30 countries, and you can see there that India and China are actually the highest. But look at the rate of growth in India from 2019 to 2025. So you can see where a lot of the growth is coming from. It's not China, it's actually India.
Yeah, these are just staggering numbers, and this is all part of this global agenda that I've covered on replacement immigration, and it is just nuts to watch this all play out. But thankfully, so many Aussies are waking up and pushing back against this. There's just no reason to be doing this. It's insane.
No, migration is way too high. We need to get migration down to a level that we can match with new housing starts, but we're way off at the moment. Now, there's a couple of other little nuggets I just want to cover before we close. This was actually really interesting. Strata agents, they're the people who actually get paid commissions quite often to arrange insurance on stratas that they're actually managing. Sometimes it can be a very large number, 15 to 20%. Actually, in New South Wales, they're now calling for that to be stamped out. So that's a really interesting observation on a really, really problematic area, because a lot of people in the rental sector are actually finding that it's the strata fees translated via investors to lifting their rents. It's not just the interest rates on mortgages, it's actually the strata fees that are going through the roof. And of course, a lot of stratas are actually defective, and so the strata fees are going up. So this is a big deal, and I've called that out for quite some time. Another interesting little break was this from the ACTU, who's now calling, as part of the submission for the upcoming productivity discussion, for one property limit on negative gearing and tax breaks. So the tax breaks conversation is now back in the agenda. And it's very interesting how the productivity conversation, which Chalmers started, is shifting more and more to discussion about some of the tax policies. And so that's a really interesting observation. We need more of that, because actually the tax system is completely broken. Corporate taxation is not where it should be. It should be a lot higher. Personal taxation is too high, and the tax breaks are too high as well. So there's an opportunity to perhaps mess with some of those things to try and deal with some of the long-term structure issues. I'm not sure the government will take it up, but I thought it was interesting that the ACTU was pushing that.
Yeah, not going to be popular with politicians that own multiple homes or property investors. But at some stage, if homelessness keeps rising, you have to say, well, at what point, I've said this before, can one person own 10 properties while the average family can't afford anywhere to live?
Right, absolutely. And tent cities are growing rather than shrinking, and more people are actually in difficulty. And in fact, that takes me to the next slide. So the latest stress data that I've just published shows that rental stress is still up there at 74.8% of households in the rental sector, very high. Mortgage stress, just very slightly down, but still close to half of households with a mortgage are in difficulty. And that's a big deal. So, this is the fundamental structural issue that we have in Australia, and it's not really being spoken about sufficiently. Housing affordability is shot. The rental sector is shot. Government policies have been very bad for a long period of time, so we can expect to see more of it. And then just on the final point about government policy, I just wanted to highlight, of course, that the U16 social ban, people are beginning to wake up to this ban, as we've been talking about. This is about control. This is about the single sort of truth. This is, YouTube's now been caught by it as well. So you can see that by the back door, they're trying to give you a digital ID because you've got to verify yourself online. And then I segue that to the final slide, which is that, of course, in euro, the digital euro is coming in October, and they're talking about it now very enthusiastically from an ECB perspective. But as this post makes the point, and we've been talking about this, the digital euro, a central bank digital currency, is coming in October. And if you join digital currency, digital ID, social credit, once installed, it'll be a prison. And that's the point. So this goes right back to our earlier conversation, where there's a really, really critical issue that people need to understand. There is a plan here, there's a plot here, and we need to be acutely aware of it and resist it.
And Mexico just introduced biometrics for all citizens as well. So this is all happening in all these countries at the same time. It's not a coincidence, guys. This is, stuff we've been talking about for years, and it's on our doorstep. So you've got to share these videos around and all that content related to these issues, wake people up, and hopefully we'll continue to do so as well, Martin.
Absolutely. One last final point, VPN growth in the UK has shot up dramatically because, of course, youngsters know how to get around the same controls that are in the UK now. And now the UK is talking about putting controls on VPNs as well. So you can see how they are pulling the levers. They are trying to be the total source of truth. Never mind statistical agencies. We'll tell you what the truth is. We'll tell you how to actually live your life. We know best. So, I come back to this idea that governments are treating us like kids rather than adults. And we need to push back.
100%. Great place to finish. Hope you guys have enjoyed that one. As always, links to follow Martin's work down below and all my work in the description. And Martin, we'll do this again next month. Cheers.
Look forward to it. Take care. Bye-bye.